So uh, order flow is actually what feeds the markets. Price is changed by the balance or imbalance. Actually, it changes by the imbalance between buyers and sellers. What I'm looking in charts is the the force relationship between buyers and sellers. So I would be looking for places where I would see um, more buyers than seller to buy, and places where I estimate there are more sellers than buyers. If I would see a place where there is a balance, I would try to wait until there is any conviction, any confirmation for either side. So, um, so I'm I'm having some people having sound issues. Everyone hear me all right? Okay. So yeah, we can resume. Okay. So this is what guides us when we're looking for key levels where we want to put our low risk and high probability trades. When we're looking for places with orders waiting to be executed, these are the places where we want to enter. But when we consider high timeframes like weekly and daily, maybe H4, we would want to drill down a little bit further into the charts to see where the exact levels, so we won't suffer um, um, drawdown before price actually reacting. Another thing that we're considering is that at any level that we're placing, we're not actually looking for a reversal in trend. Sometimes these levels just react as temporary retracement, um, and we will we can just uh, make use of um, minor bounces from these levels. And if we're lucky, and you won't hear me saying many times the word luck, but um, my my assumption on the market is that I know nothing, and when a level that I analyze is reacting, I don't know for how long it's going to react, whether it's going to be reversal or if it's just a temporary bounce and retracement, and sometimes it's just a bounce. So I'm always looking at what the charts are telling me after I enter the trade. And if it turns out to be reversal, I'll be very happy, but I'm not wishing for it on every trade that I'm entering. So let's start analyzing, and we'll start with the very obvious Euro US dollar. So, Euro US dollar. Okay, we can see that the Euro USD is actually went down and is basing around these areas. But we can also see that this basing was also slightly broken. It was broken for a level that is a mid-term. It is a midway um, level um, in that uptrend from 2002. This tells us that there is a hint for price to go lower to where we have more solid uh, demand, which is around these areas. Okay, so this would should be the next stop. What happened here is that price after faking out is going up, breaking higher highs, but for now they are being blocked by this supply at 1.2504. So when we see a situation like this, where price is not being bounced from a key level or a very solid demand, let's just test if that's the case. No. Okay. Um, then we can assume that in the higher time frame, in the bigger picture of in the long term scope of euro US dollar move, we expect that price to go lower on this. Again, we don't know where and when, and for now, where price is at, we don't have anything to do considering the weekly time frame. So we will have to drill down lower to find any potential intraday um, trades, because the longer term trade had started at 1.250. So for now, we are in a very dangerous place. As I'm showing you supply and demand levels that price is playing in between, there's also zones that do not have any supply or any demand. These zones are called, we name them compression. These are places where all the supply and demand seems to be consumed, and it's somewhat dangerous to trade against them. We can see that on all of these area. Can you see that price is pretty much choppy um, on its way down, and it's going down, and every time it goes making a lower low, it also go very deep high and taking the left orders that were staying up there, and it almost happening on every swing of the way down. So this um, zone, we call it a compression zone. And once price will decide to go back to that direction, it will have less resistance from the supply, meaning from the sellers, for all around this area. So this are the limits of the compression zone. When price will go through here, we expect it to have a very smooth upway all the way to the upper border of this compression zone, because all these supply orders were taking on the way down. So we assume there's less um, supply waiting to be executed here. So on the weekly perspective, this zone is less likely to react by the sellers. The next sellers, serious sellers that we're going to see are around this level at 1.1845. So, but yet we are looking for price to go lower to midterm demand, which is around here. And as you can see, considering compression, we have also compression around here. at this zone. So once if price is not being reacted by the demand of 1.078, um, and if it's going through 1.057, price is likely to go all the way down um, to 1.033, because this zone is all compressed and we expect less reaction in that zone. So our demand zone will be um, here between 0.78 to 0.57. This is on the weekly. To time better entry around here, um, to actually take advantage of this compression, what we are looking for is to see this zone, the 0.78 zone, reacting um, and blocking price from going down, and then price penetrating um, compression. And then once it is, we'll look for a lower time frame retracement back to buy at lower price, at better price, and then try to take the whole ride on the expression on the compression zone all the way up to 1845. So that would be interesting trading idea to try to take on the weekly. So we will be looking for um, a bounce here, a confirmation, penetrating the compression zone, some kind of retracement, and then taking whatever all the way here. Okay, so let's drill down into the daily on the euro US dollar. Um, so we had this zone drawn by the um, weekly, but we can see better demand, or more precise demand. If we drill down into daily, um, we can see that price is being um, starting its rally from around here, and when price was returning, it wasn't exactly going all the way from the breakout level. So we can consider um, this level to be the more precise demand level where we're going to expect um, any bounce. Um, so we'll be expecting the bounce from here and up. Okay, we can also see also in on the daily that every time price was making a high, making a lower low, of course it was broken, but then making new demand, new supply. Supply was taken here, supply was taken here, supply was taken here, and so on and so on. On a daily, we can see few open supplies which are around here on the 1.17160, and also this was taken, this was taken, this was not taken. So in this way we can find where we can expect um, the compression to give us some bouncing within. So these are the levels within the compression of the weekly that we can expect price to bounce off, give us a slightly um, retracement before they are going to break the levels. So it's going to be on these before they break it again. So this is on daily. So you can see that the way that I demonstrate this for you is that as much as we're going to drill down, we can spot more untouched orders, supply orders that will probably hold off the move up, but we're expecting this. The market is supposed to move in zigzags. It's supposed to be bouncing at levels. This is why it's not that easy. Um, so we should be expecting these retracements, and these retracements should be happening where there are um, available orders to go against our moves. So this is the Euro US dollar. Let me see if you have any questions. Um, okay. Okay. So I have questions if I'm using any particular um, uh, rectangle extender. It's a program that I wrote for myself just to help me out and ease my routine. Um, I can share it with you if you write me an email. Um, yeah, there's another question. If I'm differentiating between drop-based drop and rally-based rally, let me explain this to everyone so everyone will be in line. Um, well, it's very easy to spot extremes in the price movement, but as we can see, while price is moving from the very lowest to the highest, it still um, have some stations in between. These stations are basing stations. You see, price is not always on the run to one direction, and at some points it holds off, and and there's more balance between the buyers and sellers, therefore price is not moving enough. So um, let me just bring another tool. Okay, so every time price is moving from up and starting its move, it also being having these midway stations. So we have um, basing, which means there is balance between buyers and sellers. We have rally, we have another basing, we have another rally, and we actually having a very big basing. And price continue its rally and another basing, rally, basing, rally, base, rally, base, and from now on it's actually being compressed, and when price is going through the compression, it's rather doing it in a very smooth way, basing, and now drop, base, drop, base, drop, base, drop, base, compression, rally base, and so on. So This is rally base, rally base. Um, the the midway rally base rally or drop base drop are considered to be good bouncing points. If you see this base, you see that price is bounced on it. If you see this base, you see price is reacting to this. There is this sharp, which is sharp spike, which is a very quick move, but it's still um, reacting very well to this little base where it stops. Okay, so um, so rally base RVR or DBD are good places where we can expect price to have a slightly interference in its move. This is where price will likely do some retracement, um, and and this actually explain a lot of the moves that we see on the midterm. In terms of how strong it is, usually a mid range bases can be are not that strong. We expect the bounce from them, but sometimes they can actually hold um, a true reversal. We don't know. This is why at any of these bases, we have to play by confirmation. So if we considering holding through these bases, we should be also aware of what is price doing on the lower time frame and look for confirmation that is aligned um, with our target, or it's being contradicting. So we really have to be very mindful for what the reaction is actually causing. So this is on the tip of work about rally based rally and drop based drop. Okay, so let's move on to cable. Okay, in cable, we can see. I wish I had. Let's see if I have more history in this. On cable, any one of you is familiar with Wyckoff theory. Um, all this area, all this area seems to be very likely to form a Wyckoff um, event. Or what if you're not familiar with Wyckoff? I highly recommend that you go and read about this over the internet. Also, in our blog, you can read the very basic um, um, article about Wyckoff. Um, what Wyckoff is telling us is he had found that when the big players in the markets are trying to reverse the market, they would do it in a very long term. And the way, because their positions are so huge, it takes sometimes to get rid of all the orders that they having, and then getting loaded with more orders when they want to reverse the market. Um, you have to understand that big players in the markets, like hedge funds or central banks, when they have some money reserved, this is their raw material for the factory. Their money must be in the market, otherwise, it's just a waste of time. They're usually not being flat with their money because their money has to be in work. Hedge funds, this is what they do. If their money is in the bank, they've done nothing to justify their huge salaries, right? So they have to make it, put it to work. So when they have a short position for the cable, for say, and now they want to reverse their position because it's that huge. They cannot place one uh, um, request to sell that huge position. They have to get rid of it in a very smart way. So this they will get rid of a few contracts every now and then on the axis of time, and until they are fully unloaded. Um, the way they do it, they just distributing their holdings to the market, finding buyers for their orders, waiting for price to go a little bit up, and then distributing some more. And this way, they can get rid of the huge position by many small um, um, requests from the market and receiving an overall good price for that huge position. Next thing, after they are already being sold out and now they are flat, they have to do the very same again. If they were selling their shorts, it means they are actually buying to go flat. Now, when they are flat, they have to be buy to load new positions. So they're actually doing twice the same position. They are injecting to the market a lot of buys orders at two stages: once to unload and now to load. So and they still, because the position should be very huge, they will do it over time. So it takes a lot of time to do it. This is what stands behind the Wyckoff theory, and you can see um, what happens, how this event is actually forming a different, a specific um, chart formation that we can spot and realize that the big traders in the market are what they are interested, and we can see it ahead of time that a reversal is about to happen very time soon. So go ahead and read and learn Wyckoff theory. Um, I'm not that experienced in that to teach this, but good enough to spot the event. So so when I see this way of distributing and then collecting orders from the market, what I would do, I would look in terms of order flow and supply and demand analysis. I would look up for where I would like to join um, the party of the big players. So in terms of Wyckoff, this formation is not yet completed, so I would still wait. But um, for me to understand the levels, um, we can see that price is slightly was taking off the lowest. Sometimes these very tiny spikes do give us a hint or give us some warning flag that price may go much lower. I don't have further history here to see why his price is actually rejected here and not on this very lower swing. But what I am considering now is I would like to see this demand on a weekly. One second. This demand on the weekly being broken before I would like to buy anything here lower. And also you can notice these spikes that are going down are also taking all the demands levels here. So we have a compression all the way from here to here, because you see price is get the red pen. Price is broken here with that spike, and then when we have this demand created here on base, price is penetrate here. It wasn't broken, but it penetrates, and then price is going up. So the barrier of the compression here is around that level, and if price is being penetrating here, it will go all the way up, maybe fake out here, and then um, continue to go up. um, in terms of supply, we want to see this supply broken first, and we have uh, this level next to be broken. This one had broken already this supply, and this whole area is compressed. So we expect that if this price um, will broken here, we'll expect some reaction here, penetrating, and then we're good to go through these compressions and so on. So that's what we are going to expect once the Wyckoff formation is completed and give us more confirmation. Let's go over more questions. Um, okay, I've been told you don't see my cursor, so I'll try to use other stuff. Um, okay, okay, so I understand you don't see my cursor, so I'll use my red pen for demonstrating things. So I'll repeat just in brief. Um, with my red pen. So um, this area is being compressed. We're looking for price to first penetrate and break this supply level before we want to buy it any lower. If it will happen, we will wait for price to go down to around this area. This area, if we go on lower time frame, we see it's compressed. This one is compressed. So this whole area, if price is penetrating here, is good to go all the way down. So we don't want to buy against this weak demand area. If we do see a confirmation that this upper barrier of the compression is reacting, then we can buy, and we're free to go through that compression. Next station will be this supply level. Okay, this area is all consumed. It was taking this, so everything here is actually compressed. So price, once the Wyckoff formation is completed, price is free to go upward to the next midterm supply. Okay. This is lower time frame where we can better time um, the next demand, which can be here. This whole area is being compressed. So actually, um, we to manage risk on a daily basis on a cable, we have this zone. If price is penetrating here, it's good to go all the way here. So we're going to expect the bounce from the upper um, barrier of this um, supply. So we have this supply and this supply inside. From here, from up there, if we don't see a good reaction here, we can expect that this all compressed area is also going to react. So next stop to find a short or to take off your buying orders as a target would be around the higher buyer of this compression. So is that understood? Okay, I understand you don't see the pen as well. So okay, I'll find a different. Let me just try do something. Screen, screen. Can you now see my screen, my pen? Compression. Can you see my pen? Okay, okay. So it's just a different method of sharing my screen. So, um, okay, let's move on to the last one because we really have to finish for the day. We'll continue tomorrow probably for the rest. Last thing we'll do today is the Japanese yen versus the US dollar. Um, so what we can see here on the weekly is really interesting. Price is being reacted, and we're always looking for um, a reason um, why is price reacting at certain level. Um, we have to understand that when price is reacting in a very convincing way, is that is that many uh, orders were at that place. Usually, there is a reason why this place um, had reacted the way it was. So, and this will tell us that eventually these levels are actually can be defined as key levels. So we can see that price had reacted here. So we always draw a line and looking to the left and see what happened in history. So we can see that price had turned from that supply, and price went down and then based again here, and then price we're basing around. Do you see my mouse now? To make sure our price was basing here, and next time was when price was coming back, this zone was highly respected, and price from here was facing a lot of seller's resistance, and price was starting dropping and never made it to actually break this level. Usually, um, our concept of supply of demand is that usually at the first time price would test a supply or a demand level or a key level, it will react in some way. So if this level was never broken before, it's still considered as a hot zone, a hot level that we can suspect that it will hold in the next time. So that's happened at this time and created a head and shoulder formation, and it gives a very high reaction, very powerful reaction, and we can see that it was also breaking this basing, but not this one. It was actually reacted on this pennant um, formation, and from here it's going up. But still, we have um, this base that price is not going through, and we have a compression, which is um, a flagging formation, and we see that there are all every time price is progressing down, it's consume all the supply. So in that term, if price will show us go on that um, on on this area, if it will react upward and penetrate this this compression area, price is tend to um, smoothly go through the whole compression here. And the next possible bounce will be at the top of the barrier of the compression. And from that on, it may or may not break this level. If it will, next station will be here, and next station will be um, um, will not be here because it was already being tested and pretty much dipped. So we expect this level to not work anymore. So the next time we'll have um, these fresh supply to react for our um, um, for the next rally. We can also see that there is a very strong push upward from down here. So the base we see the whole base here is consumed. So that would define our demand at lower. So this would be um, the best place to actually buy. Sorry for the handwriting. And we do have a base in here. If you see this slightly basing, so we might expect reaction or early bounce from here. So that would be actually the best place to buy. If it goes lower than this, beware of this compression. The trade can work uh, against you very deep. Remember, weekly it's a weekly time frame, so there are a lot of uh, points involved in this area, like 435 pips. That's quite a lot to go on a drawdown. So guys, that has been like 50 minutes. So I hope the next days we'll do it. It's going to be shorter and more brief. Um, it's got on some educational level. I hope you like it and you can take few things of it. Um, if you have any questions, you can write us on email and we can answer you back. Or if you have some quick questions for now, I be happy to answer you. Um, it's almost um, the opening bell for London, so I hope you are prepared for the day and for the week. And we'll send you more invitations for these morning sessions. If you are Americans and you're looking for also the New York sessions, we'll start with the London and we'll see how it goes and how people like it and what it gives, if it's not confusing you guys. And if not, we'll also do New York sessions once in a while. But so this is it for the day. Thank you for coming.